Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, May 12th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Futures are again negative. Currently, we still got a couple hours to go before the market opens, but currently we have the Dow futures down about 60 points, S&P futures down 12, NASDAQ futures down 80. That is off the worst levels from overnight, but still, we are looking to continue the selling that we saw on Wednesday. Crude oil prices currently down a little over $1 to about $104.50 per barrel. The U.S. 10-year Treasury yield 2.84% this morning, down about 7 basis points. So that continues to fall. And the surprising thing to me, one of the surprises, is that we've seen the yield fall as much as we have without seeing much of a move to the upside in the market, especially in those beaten down growth stocks. So that just tells me what kind of an environment we're in, which is a toxic one for growth stocks. So we want to continue to exercise a lot of caution. I've been speaking all year about being very cautious and being very patient and allowing the sentiment to reset. I think probably everyone can feel the change that's taken place in terms of sentiment now versus where we were at the end of last year. You might have thought the market was overpriced, but probably didn't feel too bad about your portfolio and so forth. A lot of folks, there's definitely a lot of pain going around right now with the market down as much as it is. And those who are saying, hey, we're not in a bear market because the S&P is not down 20%. Well, we're getting really close. The S&P 500 yesterday, I think, was down about 18.5%, 19%, something like that from the high. So, yeah, we're in a bear market. I continue to talk about this being a cyclical bear market as opposed to a secular. Big difference. Secular bear markets, you lose about 60% of value in the market over time. It's over a much longer period of time, usually 2-3 years. I don't see that kind of market here. I just don't. Maybe I'm wrong, but I don't see that. Instead, I think it's going to be that 20 to 30% variety on the S&P 500. Normally, these are 3 to 6 months. Occasionally, you can get the really quick ones like we had with the pandemic in 2020. That was 1 month. The stock market crash back in 1987, that was 1 month. Most of them, though, tend to be at least 3 months and usually in that 3 to 6 month variety. So I think this one drags out. I think it could go as long as into September. I don't know if the bottoms drag out that long. I just don't think the market's going to have a meaningful rally until later this year. And I do think the fourth quarter is going to be incredibly strong. But I feel like we got to kind of get to that period. We got to kind of cross that bridge and try to do it very carefully because there are going to be, it's like a minefield out there. Every stock seems to be blowing up. It's one after another, one area after another, but primarily it's the growth stocks. I mean, everything's getting hit. I mean, outside of maybe a couple areas in healthcare, consumer staples names are holding up pretty well. Energy, of course, has been doing really well. Some of the materials are doing well, although they've been coming back down. But when you get into the aggressive areas, the market's been hit pretty good. Anyway, let's go through today's agenda with you. We're going to start off with daily market recap, then talking technically. Market bottoms. Just going to talk a little bit about market bottoms and how they form, so maybe we can have a little bit of advance warning as the market bottoms. Earnings spotlight, and then the 3 you must see. And before we get into any of that, let me take you over to earningsbeats.com. If you go over to earningsbeats.com, scroll down, we have a free newsletter, Earnings Beats Digest. All it requires is your name, email address, hit that subscribe button. 3 times a week, publish an article, Mondays, Wednesdays, and Fridays. Love to have you join. There's no credit card required. You can unsubscribe at any time. So it's a great way to follow along some of the things I'm thinking about the market steadily. 3 times a week, you're going to get some information. I'm really going to start digesting some of the earnings season movers and shakers. And when I say that, we do an analysis. It's the earnings reactions analysis, where we take a look at all the different sectors and how they've handled earnings season. And I think they give us pretty good clues as to what we might expect going forward. Anyway, I'm going to be talking about that more. I'm sure I'll be highlighting some of that in the EB Digest as well. But if you want to get any of that information, all it takes is name and email address. So I would encourage you to subscribe. We also do a lot of free events from time to time, and we reach out to our entire community and offer up the room instructions and so forth for you to come in free of charge. So it's another reason to be on our list there. All right, daily market recap. Well, I mean, I could almost put this on rewind from the last 4 months because we're in another one of these declines. The Dow Jones yesterday down 327 points, S&P down 66, NASDAQ down 373, almost 400 points, mid caps down 41, small caps down 19, almost 20. On a percentage basis, everything down more than 1%. And you can see the NASDAQ down more than 3%, continuing to get hit harder than the other major indices. The S&P was down about half of that yesterday, 1.65%. And the Dow down about 1/3 of that, down 1% versus more than 3% on the NASDAQ. So yeah, not a good day yesterday. The discretionary, technology, and communication services areas, these are the 3 most aggressive areas. They led this move to the downside. Discretionary 3.6%, technology 3.16%, and then communication services 1.8%. To the upside, energy and utilities. Utilities trying to hang on to support right here around 70. Energy moving back up a little bit in a trading range, I would say. I think as long as it stays above 70, we're fine. Recent highs around 82, 82.5. We need to get back up and break through that area. But overall, the uptrend in energy is pretty obvious, and it's been uptrending all year compared to the S&P 500, which has been downtrending all year, NASDAQ. So XLE has been a great place to park money and trade on a regular basis. Swing trading has been working in energy, not so much in other areas. Utilities, after pretty rough end of April, just consolidating right here beneath these moving averages, need to get a break back up above about 72.5, 73. Utilities, though, on a relative basis, still performing exceptionally well versus the S&P 500. All right, 10-year Treasury yield. Right now, well, this chart doesn't show it, but we are down about 7 basis points. Let me give you an update there. 8 basis points now, down to 2.83% from our close, which was 2.92. So pretty good move to the downside. This continues. The 20-day, by the way, is at 288. We're going below that. I've been talking about this higher yield and lower PPO, suggesting we could go below the 20, possibly even down to the 50. Well, here we go. Now, with this move to the downside, I really thought we'd be bouncing on the NASDAQ in particular. I thought we'd be bouncing in equities, period. But that has not been the case so far. Still, investors and traders very reluctant. Wall Street, particularly reluctant to get into those growth stocks. Been looking at my ratios that I like to follow, and they are all going lower still. There are no signs from a rotational standpoint anyway. There are no signs of a market bottom yet. Seems like we just need capitulation. And maybe you think we're already there, but I'll show you market bottoms in a little bit. We're not there. We're not at capitulation just yet. See, what else did we have here? Well, we had economic reports coming out later this morning. So initial jobless claims will be out 8:30 this morning. Also, April PPI, core PPI out as well. Initial jobless claims last week, 200,000. We're expecting them to drop to 190. I would be surprised. I mean, with rates going up, I think there are a lot of mortgage companies I know that have been laying off. I would expect to see initial jobless claims begin to jump based on, I mean, if we're going to go into a recession, or if we've already started one, we should begin to see some of this work its way into initial jobless claims. And so I wouldn't be surprised. Last week was a little bit of a surprise up at 200,000. I wouldn't be surprised to see higher numbers. Maybe it's not this week, but I would think in the weeks coming up, we should be looking for that number to rise a little bit. At least I would. April PPI. Okay, March headline number rose 1.4%. It was very hot. We are expecting that to drop this morning down to 0.5%. Anything above 0.5%, though, is going to be, scrutinized and talked about in the media quite a bit. April core PPI in March, we rose 1%. April expected to rise 0.6%. So core is where you strip out the very volatile food and energy. And there, I've gotten some emails in asking me about this and why, the core isn't the real number because it doesn't include energy and food. But you do have to realize that those two are extremely volatile. And energy prices, yes, they've gone up a ton, but look at the history of energy prices. They go up fast, they come down fast. If the Fed were to act every time crude oil prices spiked or went, up, down, I mean, the Fed, we wouldn't know what the heck was going on. It would be very volatile behavior out of the Fed, which in turn I think would lead to just, I'm not even sure, it wouldn't be a very fun stock market. Let's just say that. I think the Fed has it right looking at core because the volatile nature of food and energy going up and down is going to skew whether or not we really and truly have structural inflation problems. And I think we do have some structural problems right now, but I think it's almost entirely driven by the pandemic. And I think once we go through this slowdown in the economy, potentially a recession, I think that's going to help curb demand, which in effect is going to help us get inflation under control, along with the Fed's hawkish behavior right now. So that's what's weighing on the market in the near term. But I believe later this year, that is all going to be out of the way. And I think we're going to be in an environment where inflation's coming down, interest rates coming down, and the stock market's going to shoot back up again. Just my opinion. But this was the same opinion I had back in January. I said the market was going to have a rough start to the year. I even pointed out, let me show you a chart that I showed folks at Market Vision 2020. This was back when we were sitting up here. And I said, I thought we were going to work our way back into the middle of this channel. If I drew another line in here to mark the middle of this channel, you would see most of these intermediate term lows come down and test the midpoint of the channel. And then we start moving back up again. And so that's what I was looking for at the beginning of the year. We moved outside the channel. We were up at 4,800. And I talked about the possibility. I said 4,300 would be my minimum downside target. I thought we'd probably go to 3,800, which was 20% bear market territory. But I said, outlier, we could go to 3,500. And so I drew this line down showing how in the first 6 months of the year, I expected that we were going down. Second 6 months of the year, second half of the year, looking for it to come back. And where are we? I mean, now 3,900. We're in May. Maybe by June, we might be at that 3,500 rate we're going. Maybe this week or next week. I mean, the S&P, if we get into a capitulatory type thing, you can see the market drop very, very rapidly. So I think we're right on cue. And yeah, I think we're going to rebound later this year. I think that the Fed, while it's hawkish, interest rates going up, we've got crude oil prices going up, we got inflation, we got potential recession. I mean, yeah, everything's coming together, perfect storm. That's why the market's selling off. But I do think we go back and move back to the upside. All right, talking technically, let's move on to the S&P 500. So what I wanted to do first is just show you, this is where we stand right now. This is where we were. And this is the low where we closed yesterday. That's about 19%, 18.7%. And maybe one of these lines is just off slightly, but pretty close. We're almost to a cyclical bear market on the S&P 500, which again, I talked about at the beginning of the year. I'm not calling it now after we're already in it. I called this back at the end of December, early January. All the warning signs were coming together. Technical analysis isn't just about me telling you what just happened 3 months ago. Technical analysis is about making predictions about what's coming based on what's happened. That's what technical analysis is. If I wake up and it's raining outside and I tell you it's raining, I'm not a meteorologist. I'm not an expert on weather just because I'm telling you what's happening outside. I haven't studied weather patterns. I mean, the key with a meteorologist, and like love them or hate them, but meteorologists predict what's going to happen. Their credentials aren't based on telling you what happened last week. We can all do that. So same thing with the market. I can tell you what just happened. You don't have to be a technical analyst to say, hey, we're in a bear market now. A technical analyst is one who at the beginning of the period says, we've got a bear market coming. I think the two are quite different. Anyhow, S&P 500 down 19%. Now, one thing I want you to focus on is look at the volume right now. Volume's, gone up some, but I mean, look at some of the volume days we had back in February and March. I mean, here at the bottom, this low, we jumped up to 3.6 billion shares on the S&P. Yesterday, closing down at the low, 2.7 billion. Look at the volume here on this low, or over here. Actually, that's option expiration Friday. That's probably not a great example. Look at this low, over 4 billion back at the end of November. 4 billion. Coming down here, well, that's another option expiration. Yeah, see, option expiration, you're always going to have, there's just a lot going on. It's quad witching day every 3 months. So the third calendar or the third month of each calendar quarter. So you're going to have it March, June, September, and December. That's why you get those spikes. But outside of that, I mean, there's the March one right here, by the way. But outside of those days, I mean, I'm looking for capitulation. I want to see that volume, and I'll talk about this more in just a minute, but we're just not there. Now, the rest of this chart that I wanted to show you, here's the NASDAQ 100 relative to the S&P 500. Now, we actually started going down during December, but notice since the beginning of the year, when you go down, the market goes down, those high growth stocks on the NASDAQ get hit harder. They're more heavily weighted. Because you might say, well, Apple's on both indices. Well, Apple is in both indices, but Apple is more heavily weighted in the NASDAQ than it is in the S&P 500. And Apple broke down yesterday, by the way. And beginning of the year, I wrote an article. I thought Apple could go to 140. It was at 180 at the time. I took a lot of flack on that one, but it's 146 now. So almost down to where I had talked about. And I think if things really got bad, Apple could go down to 120, but I think 140 would be a pretty good price to begin accumulating Apple. Anyhow, crude oil prices. So from 65 or whatever up to 100 and whatever it was, or was, we got up to 130 or close to that. Anyway, this low to this top, roughly 90% move to the upside in crude oil prices. 10-year treasury yield from the low to where we just peaked at 316, went up 136%. And down here on the bottom, this is core CPI. And what I did, because this is a daily chart, I put in a rate of change, 253 days, which is roughly 1 year. Now, the CPI only comes out once a month, so this is kind of a weird looking chart, but it still tells you basically what we need to know, which is that inflation has been rolling. We are now at 6.13%. We were up a little bit higher. We just came down with the reading yesterday for the core CPI. But we've been in certainly a surging environment for inflation. And so that's reflected here on this chart. Now, the reason I did this, I've drawn some parallels, 2022 back to 1990. I mean, now we've got also in here the Ukraine-Russia war. Back in 1990, we had the Persian Gulf War. Look at the chart, though. I'm going to give you the exact same chart, S&P 500. This is 1990 and 1991. So this was the period where we saw the selling. I mean, the S&P went from 370 down to almost 290, 20%. Well, we're at 19% now. Very similar. This occurred over 1 to 3 months. So far, what we've gone through has occurred over about 4.5 months. So a little bit longer. But basically, the percentages are about the same at this point. The NASDAQ versus the S&P 500 during that period also went down, which is what I would expect. Crude oil prices. Remember I said crude oil prices this year gone up 90%? Back in 1990, during this pullback, crude oil prices went up 147%. The 10-year Treasury yield. Now, we were already up over 8% then. So we weren't coming off of 0% rates. So definitely it was a completely different environment than what we have now. I would argue this is a better environment that we're in now, because rates, even though they've gone shooting up, are still pretty darn low. I think very conducive for growth, business growth, for growth in our GDP. Much easier to grow at 3% than it is at 8 or 9. Anyway, just wanted to point out the 10-year Treasury yield was going up during this period. Here's the core CPI. It was going up. We had inflation at this point. You know, when we were bottoming in the market, inflation had reached about 5.6%. A lot of similarities. Look what happened afterwards. Now, I know all the bears out there are going to say, oh, this time's different. Okay, we'll see. We'll know in a year. I believe in a year we're going to be back at the highs in the S&P 500. I predicted, by the way, back at the Market Vision 2022 event, the S&P 500, of course, topped a little over 4,800. And my prediction was that we would finish the year right about where we started the year, that we were going to have this big decline, and then we were going to have big rally. Now, I don't know if we get all the way back up to 4,800. It really depends on how long this plays out, how long the Fed, keeps the brakes on the economy. The one problem the market has now that it hasn't had for a while is that it doesn't have the Fed to help out. The Fed's got inflation. The Fed's hands are tied. It's like waiting for Superman to show up when he's got kryptonite sitting next to him. There's just not, they're not coming. There's no Fed to help out right now. So we've got to kind of weather this on our own for the next couple months. And that's a little bothersome. Some of you might think, well, that's the way it's supposed to work. Well, no, actually Fed is there to maximize employment, stabilize prices. And right now they're focused on stabilizing prices. So they can't really worry about the employment side. And so actually they probably want a recession because that lowers demand, which in turn lowers inflation pressure. So don't expect the Fed to come running in this time. It ain't happening. So the next couple months we're on our own. And that is a little bit scary when you go into capitulatory mode and there's no Fed to help you out. All right, let's move on to market bottoms. So I just wanted to go very quickly and take a look at the S&P 500. A couple of things. This is a 20-year chart of the S&P 500 down here, by the way. It's daily. Now, during the really, really bad markets, 2002 low, 2009 low, and 2020 low, the pandemic low, look at the daily PPO and how low we got. I mean, -5 or below. And that's the only time we've seen the PPO on the S&P 500 get the -5 or below. Many of these other bottoms that we saw, 2010, 2011, 2016, 2019, or, late 2018, all of these bottoms, look at where the PPO got to, -3, -2 and change. -2 or -3 and change, -2 and change. And even the early part of the 2008 crisis, 2007, 2008, we saw lows, -2 and change. That historically is where we kind of bottom, and we're at -2.563 right now. I don't think we're heading for any of these. Disagree with me if you want, that's fine. That's what a market's all about. Everybody has their own opinions. I don't think we're going down there. So the question is, how far do we go? I mean, I think we're going to probably get into the -3s, especially with no Fed to help us here. We're going to probably have to suffer through a bit more. I think the S&P goes to 3,500, and I think when it gets there, we're probably going to have that PPO somewhere in the -3s. And I would be looking for a bottom. I think we got maybe 10% more on the S&P 500. And again, I'm not just coming in Monday morning quarterbacking. It's the same numbers I talked about back in January. Nothing's changed in my view. We needed to reset sentiment, and that's really what we're doing. RSI on the daily chart, you can see, usually when you get down the bottoms, you're somewhere down in the 20s. Doesn't happen very often. We're almost there. We were there back in January and we bottomed temporarily, but we probably need to get back down into that RSI upper 20 range, mid to upper 20s. And again, I think that's going to coincide with any kind of a movement down in the mid 3000s. Earnings spotlight, going to go through these kind of quick, just a couple of them. Disney's down 4% pre-market. They missed on their earnings, $1.08 versus $1.20. I saw a number of companies missing, but there were a couple that actually have gotten some pretty positive reactions. One was APP. They came out, they were expected to lose 3 cents. They actually earned a profit of 18 cents and the stock was up 17%. But it's 17% after you've already taken a huge dive to the downside. So the growth is there, but these growth stocks are just not in favor. So it's probably going to gap up and fall back would be my guess. One other stock that did pretty well, was reacting pretty well, was Rivian, RIVN. But again, it's been down so much. They beat estimates. They were expected to lose $1.50. They lost $1.43. Stock up 5% pre-market. All right. 3 you must see. I'm going to try to get through these kind of quick, but I just want to show you 3 industry groups relative to the S&P 500 that are doing extremely well right now. Healthcare providers. Now, down here on the bottom shows you the actual price chart, absolute price chart. So you can see it's not at a high. It's been going down over the last month or so, but it's not going down as fast as the S&P. So its relative strength continues to improve. So here's one group that's been doing well. Second group that I wanted to show you, pharmas, relative strength. Look at that relative strength. Again, it's come down since early April, but its relative strength shooting through the roof there. And then lastly, you may not realize it, but soft drinks doing really well on a relative basis. They're actually close to their all-time high in absolute price and relative price shooting straight up. So a lot of money rotating there. Anyhow, that's it for me. Really appreciate you tuning in. Please be careful out there. When you bottom or in the process of bottoming, sometimes the market loses its most in terms of percentage. That's the scary part about capitulatory bottoms. So we've got to be very careful about impulsive selling to the downside. Anyhow, have a great rest of your week. Enjoy your weekend. I'll be back on Monday over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.